John Pattullo, Fund Manager of Henderson Diversified Income Limited. So in the second quarter of this year, how have fixed income markets performed?
Well, actually, Q2 was a tougher quarter for Henderson Diversified Income than Q1. Q1 we made reasonable capital, and Q2 we lost a little bit of capital. So net on the year we're broadly flat. So the vast bulk of the return, which is what we've been saying all year, will come from the income. The income stream is absolutely fine, it's sustainable and achievable. But in bond markets, given current valuations, it's a lot harder to make capital for the shareholders at the minute, and certainly in Q2 where we lost a little bit of capital, principally because of risk aversion. So as was well flagged up in the press, German 10-year bond yields got to ridiculously low levels. There was a bit of a bubble there, and then they backed off quite a bit. And then towards the end of quarter two, obviously we went into the Greece crisis, and credit and equities were actually quite weak, especially in June. So that made life a little bit harder for us. But that's not the capital's not gone away. There's no default problems in the portfolio. It's just prices have fallen a little bit as yields have risen.
Okay, so in terms of the portfolio, any new positions, any significant asset allocation changes?
Not wildly. I mean, loans are around roughly 27% in the portfolio. So they have fallen actually for a couple of years now, as we have preferred high yield and investment grade. And generally that's been the right asset allocation tool. Having said that, most recently loans have been actually outperforming because the volatility has been low. There's a lot of demand for loans from CLOs with fairly limited supply. So I think the loan asset allocation is probably bottoming around 27%. I'm not convinced it'll go much lower than that. But again, you know, we look right across the capital spectrum of any company. So you might well have a company which has got a loan, a secured loan, might have a secured bond, maybe a floating rate note bond, or a fixed rate bond, and might have a junior unsecured fixed rate bond as well. So we don't always entirely look bonds and investment grade and high yield, because we might pick off different parts of those assets within the same company.
Okay, finally, John, what's your outlook for the coming period?
Outlook is pretty much it's about income. You know, we need to generate a good, sustainable, achievable income for the clients. That's what we're very much focused on. Default rates are at very, very low levels. We tend to lend to large, non-cyclical businesses, which might be quite levered themselves, but their cash flows are quite stable. And I think the income stream is fine, but as I said earlier, I think making capital from these valuations is a little bit tougher. Valuations have got a bit cheaper on the back of Greece, so we have added a little bit of risk into the portfolio and added gearing up a little bit higher. So we locked in some good yields there. But going forwards, I think it's generally about generating a good, reliable income stream for the shareholders.
John Pattullo, thank you.
Thank you.